Hello everyone and welcome to our video on 8 mistakes people do while investing and how to avoid it. Investing can be a great way to build wealth over the long term, but there are many pitfalls that can trip up even the most experienced investors. In this video, we'll discuss 8 common investing mistakes and provide tips on how to avoid them. So, let's get started. Mistake number 1. Not having a plan. One of the biggest mistakes that people make when it comes to investing is not having a plan. Before you invest any money, it's important to take the time to define your investment goals, risk tolerance, and investment time horizon. By doing so, you'll be better equipped to choose the right investments that align with your goals. One of the world's most successful investors, Warren Buffett, cautions against investing in companies whose business models you don't understand. The best way to avoid this is to build a diversified portfolio of exchange-traded funds, ETFs, or mutual funds. If you do invest in individual stocks, make sure you thoroughly understand each company those stocks represent before you invest. Mistake number 2. Focusing on short-term gains. Another mistake that people often make is focusing on short-term gains. It's important to remember that investing is a long-term game. While it can be tempting to try to make a quick profit, it's much more important to focus on long-term growth and stability. A slow and steady approach to portfolio growth will yield greater returns in the long run. Expecting a portfolio to do something other than what it is designed to do is a recipe for disaster. This means you need to keep your expectations realistic with regard to the timeline for portfolio growth and returns. Mistake number 3. Following the crowd. One of the biggest mistakes that investors make is following the crowd. Just because everyone else is investing in a particular stock or asset class doesn't mean that it's the right investment for you. Do your own research and make informed decisions based on your own goals and risk tolerance. Too often, when we see a company we've invested in do well, it's easy to fall in love with it and forget that we bought the stock as an investment. Always remember, you bought this stock to make money. If any of the fundamentals that prompted you to buy into the company change, consider selling the stock. Mistake number 4. Not diversifying. Another common mistake is not diversifying your investments. By putting all of your eggs in one basket, you're exposing yourself to unnecessary risk. Instead, consider diversifying your investments across different asset classes and sectors. While professional investors may be able to generate alpha, or excess return over a benchmark, by investing in a few concentrated positions, common investors should not try this. It is wiser to stick to the principle of diversification. In building an exchange-traded fund, ETF, or mutual fund portfolio, it's important to allocate exposure to all major spaces. In building an individual stock portfolio, include all major sectors. As a general rule of thumb, do not allocate more than 5% to 10% to any one investment. Mistake number 5. Trying to time the market. Trying to time the market is another mistake that investors often make. No one can predict the future, and trying to time the market can lead to missed opportunities and costly mistakes. Instead, focus on a long-term investment strategy that takes into account market fluctuations. Trying to time the market also kills returns. Successfully timing the market is extremely difficult. Even institutional investors often fail to do it successfully. A well-known study, Determinants of Portfolio Performance, Financial Analysts Journal, 1986, conducted by Gary P. Brinson, L. Randolph Hood, and Gilbert L. Bieboer, covered American pension fund returns. This study showed that, on average, nearly 94% of the variation of returns over time was explained by the investment policy decision. In layperson's terms, this means that most of a portfolio's return can be explained by the asset allocation decisions you make, not by timing or even security selection. Mistake number 6. Paying high fees. Investing can come with fees, but paying high fees can eat into your returns. Make sure to research the fees associated with any investment you're considering and look for lower-cost alternatives. Turnover, or jumping in and out of positions, is another return killer. Unless you're an institutional investor with the benefit of low commission rates, the transaction costs can eat you alive. Not to mention the short-term tax rates and the opportunity cost of missing out on the long-term gains of other sensible investments. Mistake number 7. Reacting emotionally. Investing can be an emotional experience, and reacting emotionally can lead to costly mistakes. Instead, try to stay focused on your long-term goals and avoid making impulsive decisions based on short-term market movements. Perhaps the number one killer of investment return is emotion. The axiom that fear and greed rule the market is true. Investors should not let fear or greed control their decisions. Instead, they should focus on the bigger picture. Stock market returns may deviate wildly over a shorter time frame, but, over the long term, historical returns tend to favor patient investors. In fact, over a 10-year time period, the S&P 500 has delivered a 11.51% return as of May 13, 2022. Meanwhile, the return year-to-date is -15.57%. An investor ruled by emotion may see this type of negative return and panic sell, when in fact they probably would have been better off holding the investment for the long term. In fact, patient investors may benefit from the irrational decisions of other investors. Mistake number 8. Not monitoring your investments. Finally, it's important to monitor your investments on a regular basis. By staying up to date on market trends and keeping an eye on your portfolio's performance, you'll be better equipped to make informed decisions and avoid costly mistakes. Conclusion. So there you have it, 8 common investing mistakes and tips on how to avoid them. By taking the time to develop a solid investment plan, diversifying your investments, and avoiding emotional reactions, you'll be on your way to building a successful investment portfolio. Give this video a thumbs up if you enjoyed it. Drop a comment down below and let us know your thoughts. Spread the love by sharing this video with your friends and family. Hit the subscribe button to join our community and stay updated on our latest content. Don't forget to click the bell icon to receive notifications whenever we upload a new video. Thanks for watching. We will meet in the next video. Until then, bye bye.